Global Opportunities is well positioned in its own right to be an attractive alpha generator in clients' portfolios. Especially in the point in time that we're in today, the portfolio tends to be relatively balanced compared to the benchmark, and that's leading to a differentiated set of outcomes and a element where we believe the strategy is a diversifier for clients' portfolios. So in its own right, we think that it can add attractive alpha generating capabilities, but in a context where the US market has been such a strong outperformer over the last 15 plus years, it is likely that many clients may have portfolios that tend to skew or weigh more heavily to the US. In Global Opportunities, we feel that it can add a diversification element in those portfolios where we can come in. We tend to be and have been for the last number of years underweight the US, but have been able to generate attractive returns relative to the US component of our index with a much lower level of correlation relative to US holdings in the benchmark. Very thoughtfully and with a fair degree of rigor when we allocate. So when we're looking to construct the portfolio, it tends to be concentrated about 30 to 40 holdings. But what we're really looking for is quality businesses as we think about them. And those kind of businesses, we feel that if we buy them at the right price, the returns and the risk reward skewness should be quite attractive for clients over time. We also then take time to consider the fundamental drivers of those businesses and over time we feel that we can balance the portfolio. So get attractive, embedded kind of rates of return in the portfolio with good balance in terms of investment theses. And that's generally led to a portfolio where, while concentrated, we've had very attractive kind of downside capture ratios while still being able to add alpha in the up periods as well. Usually it's through the fundamental research is the way we're trying to balance. So first and foremost, by focusing and understanding the businesses that we own, I think one of the benefits of the level of concentration is that we can really zero in on the fundamental drivers that are driving the companies in the portfolio. And then when we couple that with valuation, and if we solve for a high enough rate of return before we allocate capital to those names, that balance in the mix of the two essentially allows us to have conviction while exposing us to what we think are attractive risk-reward skews. I think in the short term, it would be, given what the valuations are, global markets, so the premium the US trades on relative to the rest of the world, it's likely that we will have an underweight to the US. Now that's not a top-down target. I think that's more reflective of the reality that the US has been quite an exceptional market and economy over the last 15 years. What that's allowed, though, is outside the US, is that you have really interesting, attractive businesses that are not getting as much attention as they deserve. And so the valuation tends to be quite attractive. And given the flexibility that our mandate offers us, we're able to go and allocate to those names where we think we're buying great companies at exceptionally good prices. So that improves the margin of safety, but will still allows us to have exposure to really attractive kind of return profiles. So given that mix today, we're comfortable having this type of an allocation. Certainly, if there was to be something of a correction in the U.S. market and valuations were to become more reasonable, we're comfortable allocating more to the U.S. at that point in time. Valuation discipline for us is a reflection that for the level of quality that's on offer, is the price that we're being asked to pay reasonable for that particular asset? Our view is that we have better outcomes for clients by first ensuring that the businesses we are allocating capital to are of superior quality, and then being thoughtful in terms of whether or not at this point in time is the price that we're being asked to pay attractive and allow us to have the kind of embedded rate of return that we like to have. If no, we can wait for a better opportunity. But often if we do feel that it is the right point in time to allocate capital, that allows us to get exposure to great companies at good prices. Certainly. So all the names in the portfolio tend to have three characteristics that we try to solve for. The first is that quality angle. So the way we think about quality is they tend to be companies that compete in essential industries. And in those industries, we tend to have companies that are market leaders in some capacity, maybe the biggest market share or the best technology or maybe the best intellectual property. So they have some advantage that will endure over time. So that gives us confidence that the fundamentals of those businesses should be something we can project and have some conviction on over the medium term. The second component is that for some reason, there is a valuation mispricing. Maybe there's been some disappointment in the short term, or maybe some elements of the business have yet to be appreciated by the marketplace. But those essentially allow us to have a rate of return on the holding that's above average. And then lastly, there's a visibility in the business where there is a catalyst pathway that we can say, if these were to play out, it would likely drive the valuation of the shares higher. So having that final component helps ensure that we have a portfolio that's competitive and dynamic, despite the level of concentration that we have exposure to.